Yeah, look, I think that there's a reckoning that's happening across both crypto and Wall Street, which is the Wall Street folks are realizing that Bitcoin is real and it's going to be here to stay. At the same time, the crypto people are realizing that Wall Street plays a very different game. Wall Street actually does not want an asset that goes up, 100x and then drops 80% every 3 to 4 years. They want something that is much more predictable, much more stable. And
So why'd they get so involved with it?
For Anthony Pompliano, the drama around price targets and wild predictions is just background noise to a much bigger shift. On one side, institutions are waking up to the reality that Bitcoin is not a joke or a fad. On the other, early crypto natives are realizing what it really means when Wall Street shows up with trillions of dollars and a very different definition of acceptable risk. The reckoning he describes is not just about price action, but about expectations, time horizons, and what kind of asset Bitcoin is allowed to become in the heart of global finance.
Well, because Bitcoin is not as risky today as it used to be, right? If you were buying Bitcoin in 2012 or 2025,
it was at 125 about a month ago.
Of course, but if you think about the risk you take, you should get paid for. And so right now, Bitcoin is much less risky today than it was a decade ago. And so people are going to get a lower return. Now, what I think is really interesting is also that lower volatility in Bitcoin is allowing these large pools of capital to come in and start playing.
Pompliano reframes the usual complaint that Bitcoin does not swing like it used to. To him, the shrinking risk profile is exactly what unlocks the next phase. As an asset matures, its upside may compress, but that stability is what invites pensions, sovereign wealth funds, and asset managers to participate at scale. The reckoning here is emotional as much as financial. Early adopters who thrived on chaos have to accept that a safer Bitcoin is also a less explosive one, even as that trade-off may be what cements it as a core part of the modern portfolio.
And so, in a weird way, the volatility coming down is opening up the total addressable market of Bitcoin. And what we have seen is less volatility to the upside, but that likely also means less volatility to the downside. Usually in bull markets, you see 4, 5, 6 different 30+% drawdowns. We haven't seen that during this bull market. And so you're just getting dampening of volatility over time, which frankly is boring to a lot of the early investors. And I think that's why you see a lot of those guys starting to sell.
If you don't take her price targets into account, the point she was making, I thought was interesting.
Here he leans into one of the paradoxes of success. The same smoothing of drawdowns that risk managers dream about is what makes old-school Bitcoiners feel like. The magic is fading. Yet that boring profile is what an institutional world demands if Bitcoin is going to sit alongside equities, credit, and real estate in formal allocation frameworks. The reckoning, then, is a transfer of ownership and culture. From thrill seekers to allocators, from the loudest voices on social media to the quiet committees that rebalance portfolios every quarter.
I think I've been coming on here and saying, hey, we know for sure that people want to use it as a store of value. Maybe one day it'll become a medium of exchange. The question of always are you going to buy your coffee with it? The hard part about using Bitcoin for transactions in that manner is if you think Bitcoin is going to appreciate, you don't want to spend an asset that is likely to appreciate in the future.
The guys that bought the pizza that now
correct. And so instead, what do? You spend something that you think is going to depreciate over time, which is the U.S. dollar. And so the rise of stable coins, I think, is really just taking the exact same asset, it's the U.S. dollar with the same monetary policy. You're putting it on new rails. And what we're finding is that the demand for dollars was way higher than we ever thought before.
Pompliano draws a clear line between what Bitcoin is good at and what it is not. The dream of buying coffee with Satoshis runs into a simple human reality. People do not like spending something they believe will be worth more tomorrow. That function is better served by dollars wrapped in code, moving as stablecoins over global payment rails that never sleep. In this view, the reckoning comes from abandoning the fantasy that one asset must do everything Bitcoin settles into the role of long-term store of value, while stablecoins quietly reveal how much the world actually craves dollars, not local currencies, when frictions fall away.
right? And so I think that what people are really trying to figure out is it correlated? Is it non-correlated? Is it inversely correlated? And part of it is that Bitcoin is still in this transition period. My friend Jordy Visser's got this great way of framing it. He says Bitcoin is having its IPO moment. And the whole idea is that you have the early holders of Bitcoin who are dispersing that Bitcoin into the market. And there has been billions and billions of dollars of sales of Bitcoin coming from those early holders. Yet the Bitcoin price is still at $100,000. And so there is this persistent bid coming from the traditional financial system saying, we want to buy the Bitcoin.
The IPO moment analogy shifts the narrative from daily candles to a generational handoff. Early believers, miners, and whales are the insiders, finally selling portions of their stake into a marketplace filled with ETFs, funds, and institutions that did not exist a decade ago. That ongoing distribution is not a sign of failure, but of maturation, where a once niche asset becomes widely held collateral in the global system. The reckoning here is about ownership. Bitcoin is leaving the tight grip of a small group and entering balance sheets, products, and strategies that will define how it trades for decades.
Look, there's always some, person who's going to point out the kind of 0.0001% chance of software
quantum computing,
or quantum computer, whatever. Right? But I think for most people, they see Bitcoin as not going away. It's here to stay. And I think that's why you see these large pools of capital starting to participate.
People that think it's going to zero never short it.
Listen,
I would short it if I thought it was going to zero.
The market is the referee. If people for some reason think it's going to zero,
that's a luxury belief. That's what I call it, because nothing can happen. You can believe it. Henry Blodgett still thinks it's going to zero. It's either going to 1 million or to zero. It's a luxury belief. You can have it, and no one's ever going to call you out on it, but you're never going to short it because you don't ever put any money down.
Here he goes after one of the longest-running talking points around Bitcoin, that it could still go to zero at any moment. In Pomp's framing, that fear has become more of a posture than a position. If you truly believed in a collapse, you would bet against it rather than repeat the line on television and in op-eds. As governments, corporations, and funds accumulate exposure, the odds of total failure shrink into the realm of exotic edge cases like catastrophic bugs or unstoppable quantum attacks. The reckoning is that critics must either engage with the asset as it exists today or admit their argument has become a cost-free slogan.
I do think that there is a theme that is happening right now that people have not yet wrapped their head around, which is this whole idea of crypto is going to be dead in a decade, right? People are not going to be talking about crypto. We're just going to talk about finance. Everything is now merging together. You have the crypto world and you've got the traditional finance world.
So crypto will be just so intertwined with the financial world that we won't even use the term?
We used to think about the internet, like internet finance, and then there was the finance industry. Now it's just finance. Same thing's going to happen with crypto, right? BlackRock, as an example, BlackRock could be described as a crypto company. Their most profitable product is their Bitcoin product. They're talking about tokenization all the time. Like, they are trying to adopt these new technologies. All of the big asset managers, they're trying to figure out, how do we play here? Do we actually have funds that invest in this space? Do we tokenize our funds? What do we do? And so over the next decade or so, crypto as a concept is going to be dead, and you're just going to hear people talk about finance. And I think that's a good thing. That's the maturation of the industry.
In Pompliano's view, the end game is not a separate crypto industry standing apart from legacy markets. It is a fusion that becomes so complete, the labels fall away. Just as no one now talks about internet stocks as a distinct category, he expects the same fate for crypto language. When the world's largest asset managers derive key profits from Bitcoin products and talk openly about tokenizing funds, the line between old and new dissolves. The reckoning, then, is semantic and structural. This is not finance, plus a speculative toy, but finance itself retooling on programmable rails.
Look, I think that what people forget sometimes is how quickly everything is accelerating now. One of the things that we've done is we've launched a software product called Sylvia that allows somebody to come in and they can attach their bank account, their brokerage account, their crypto account. They can upload their real estate, their private investments, their credit cards, all this stuff. And the AI goes to work and starts to immediately begin helping them get their financial life in better order, right? It's kind of help you grow your investment portfolio. And the reason why that's important is because now all of a sudden software can replace financial advisors or your stockbrokers.
This is where his thesis extends beyond Bitcoin itself. The same digital rails that carry coins and tokens can also carry data about every corner of a person's balance sheet. Once that information is unified, intelligent software can begin to make recommendations, automate decisions, and displace roles that once belonged to human advisors. The reckoning here is professional. If Bitcoin, stablecoins, and tokenized assets are bricks in a new system, AI is the mortar that binds them into a structure that is faster, cheaper, and more unforgiving to legacy business models that refuse to adapt. Across this conversation, Pompliano paints the Bitcoin reckoning as a multi-layered shift volatility is compressing, not because the story is over, but because the asset is graduating into the core of the financial system. Use cases are sorting themselves out, with Bitcoin leaning into store of value, while dollars ride as stablecoins over borderless payment networks. Ownership is moving from concentrated early holders to a broad base of institutions, even as AI-driven tools begin to reshape how individuals interact with money at every level. Above it all is a deeper transformation of the system itself, from analog to electronic to truly digital.
Bitcoin is attacking store of value. We think stablecoins are attacking medium of exchange. We think tokenization is going to attack the stock market. It is the digitization. And the framework I've been talking about since 2018, 2017 is we had an analog financial system. We then upgraded it to an electronic QSIP system. So you used to have a physical stock certificate, a physical deed in your home, et cetera. It all became electronic. Now we are going from the electronic QSIP to this digital world. It's the same assets. It's the same market structure. It is just now going to be in a different form factor, and that allows all the software to get to it.
As this digital shift accelerates and the Bitcoin reckoning unfolds across Wall Street and beyond, do you see this as the moment to lean into the new system being built? Or do you think the risks and uncertainties are still too great to justify that kind of conviction?